Rules of the Startup Game. The Startup Guide to Startups.
We have a full house today. On my left, 3 entrepreneurs who are in different stages of funding their organizations. And on my right, 3 advisors. I want to start off with Ingersoll Jayakumar. He's the founder and CEO of ZingB. He's at the very first stage of funding his organization. This is your very first round that you're attempting to get in place. And you have many basic questions before you approach funding. Go for it, Ingersoll.
What I would want to know is about the valuation. How is it being done for a startup in terms of valuation? How is it compared to the US market and the Indian market? If a company is in India, is it valued the same way as the US market?
Like, understand what you're looking for from the money. Then you'll ascribe a different value to each person based on what you're getting from that person. Now, it comes back to, okay, what do I need to get to the next milestone? Let's say you decide I need $1 million to hit my next milestone. Generally speaking, your dilution will be the same at the beginning, whether you take $200,000, $500,000 or $1 million. Within this range, let's say, you're going to end up diluting about 25%, 20 to 25%. Now, so that implies a different thing for valuation, right? Whether you took $200,000, your valuation is one. If you took $1 million, your valuation is different. But I didn't decide the valuation and then tell you how much money I'm going to give you. It's actually it went the other way at this stage. I know later on we'll talk about later stage businesses. Those businesses are based on metrics. Your business is based on what do I need to get to the next milestone.
Over a series of rounds, which is not gonna, you're not gonna do one round and it disappear, it all equals out. So what I believe is that you may be hit badly in the first one because you found the guy who understood your vision but didn't give you exactly, took a lot. The second round will even out. So and if you're doing well and you're doing it well for 5-7 years, eventually your cap table will have flattened out to such an extent that it will be pretty much the best of what cap tables look like, unless you were some real genius who got robbed, in which case you'll start another company and do it even better.
The next question that comes from Ingersoll is a multifaceted question, and I think at the very heart of it, it deals with the balance of rights between an investor and an investee company or a founder at the very first stage of funding, right? So he has questions, for instance, can I put in a timeline to a ROFA?
Right of refusal.
Yeah, or how limiting should a non-compete be? Would an investor have a right to determine director compensation in my company? Can an investor reorganize a company without the CEO's agreement? I think at the heart of it, where does the balance of rights lie?
What are you looking for out of this relationship, right? We're getting married. There'll be items that you won't agree on, and there'll be issues that you might not align on. But like I said at the beginning, I think that what are we in it for? We're in it to build a business. So if you come back and you say, listen, I want to take, I'm going to raise 5 crores and I'm going to take a crore salary a year. We got a bit of a problem. The biggest thing that you'll be shocked at when we start to invest money is you'll say, I'll ask you to sign an employment agreement with your company. So this will be a shock to many people because I started my business. Now suddenly you're asking me to sign an employment agreement with my company? Where did this come? And then there'll be a clause in there that says termination. And you'll say, what does this mean? Why am I getting terminated? Say, look, you're not getting terminated. So again, look, I think a lot of these...
But you're doing all this to protect your money. My question is, please wear his, stand in his shoes. What does he need to do to protect his position?
He knows issues. I need to put him in my shoes for a second so that he understands why we talk about these issues. So now, in all of this, what I'm protecting for are the worst case scenarios. And in these worst case scenarios, so you asked about director compensation. That's one that I remember from that list. Look, we're aligned, like Alok said, we're aligned. We're building a business, so that's not as contentious. So your proposal, the way to, it's not a protect thing, it's a statement. It's, here's what I believe I need to live. I need 12 lakhs a year to live. I need 20 lakhs a year to live. Okay, let's talk about it. What are your expenses? What are the realities of life? No one wants you to starve. So you need to build the business.
Yeah. You know, a lot of VCs will ask you to pledge your shares back and claw them back or earn them back. So you actually have an earn out of your own shares. And you know, as a first time entrepreneur, you'll be shocked, but there's so many realities. I mean, you might just not be the right guy to build the company, or you might just run away tomorrow.
Actually, I'll give you a great example. Yeah. So we do ask you to vest your shares.
Yeah, exactly.
But the vesting, let's imagine it wasn't just you. You have 3 co-founders.
Yep,
You've known each other for 3 months, 4 months, 5 months. You all started to work together. Now suddenly you start going down the path and you realize, well, actually that guy's not as good as we thought.
Yeah.
You know, that's a bit of a problem. Now, forget us protecting ourselves. These clauses protect you. Because suddenly you realize this guy's not the right person for me. Now, if you didn't have anything like this, he would take 33% of whatever you guys had at the beginning, walk out the door, and the day you built value for it, cash out and go away.
So if I just may add, just a small sentence more. We mentored another company where the CTO got a fabulous job offer from Google, which he never thought he'd get. He actually ditched his own company and he walked out. Now the remnant unvested shares could be used as a carrot to get another quality CTO into that company without diluting anybody else. And when we told him, he got it. He said, yeah, I mean, I don't have half my shares and they're going to be used to expend to get someone else. And not as good as you, but you're walking off to Google and we're not here to build another Google yet. So how do we build someone, how do we get 10% to someone else? And it's going to come out of your pocket.
You wanted a limiting right of first refusal. I don't think you can. I mean, look, part of the benefit of putting in money is that there's some standards that exist. If I've put in this much, then, quite honestly, I've gotten in early, I've helped build this, I would like the option to come in later. Now, if you want to limit my time on that, then I'm not getting what I would like out of it, the relationship. So it's that part of it. So I don't really think there's a protection or a time limit that you can ascribe to that.
So the time limit is, say, for example, if you go for the second round, okay, the right of first refusal goes with the investor A, was like, who I have to discuss with them, show them the data, and they take a call whether to go for it or not go for it, or whether they go for it.
So usually they have a pro rata right, not a right of first refusal. So it's bad for the investor. So here's one point. It's bad for the investor as well to have a right of first refusal in that. So even when you take a strategic investor, one of the concerns you'd have is, if that guy has a right of first refusal, he doesn't exercise it, that's a signal to the market, right? Clearly, you have the right to invest, you decide not to. So typically what you say is, I'd like a pro rata right. And so if I have a pro rata right, that means if you're going to raise $10 million, I own 20% of the company, then I have the right to put in $2 million of that. So I can continue to participate at the same level.
Yep.
So the pro rata is there. The right of first refusal actually usually kicks in with the strategic investor. Venture investors, and even with strategics, we tend to dissuade them from that for the same reason. Because if they're not going to buy the company, then ultimately they're acting like a financial investor. And what's best for the company then is that there isn't anyone with a right of first refusal.
Well, that's the understanding, that the right of first refusal ultimately will drive valuation down. Yeah? Because if you look at right of first refusal and compare it with, for instance, right of first offer, yeah? Now, if you have a situation where the transaction costs are very high, the ROFR in that investor's hand is worth a humongous amount. No one's going to come to you. So you have no incentive to go out in the market to look for a strategic investor as well. And that's the kind of dynamic understanding. When you get to a VC which talks to you, they understand that. It's not as if, we want the ROFR in there and we're going to have it, and then you're worried about how you're going to get the seller. If you don't like the ROFR and the ROFR is still there despite the rights issue which you're talking about, then you can start making a case for a ROFO. Yeah? And if there is, one of the arguments is informational asymmetry, because the investor doesn't have the same amount of information in there. And that affects the ROFO much more than it affects the ROFR. And that's why he wants the ROFR. If you're able to satisfy that informational asymmetry, or if you're able to bring enough quality information on the table, or if you've evolved into a relationship which, it's very transparent and there's a two-way street in that information, I think automatically he'll drop the ROFR. He understands it drives valuation down.
Rules of the Startup Game. The Startup Guide to Startups.
We move on to Vikram Vora. He's the CEO of My Dentist. He's in his second round of funding. The first round came in from Seed Fund. That means Vikram's been married, since we're using the marriage analogy for a while. Married for a while now.
Yep.
Okay. And he has several interesting... Okay, still with them. He has several interesting questions. And the first one starts with multiple term sheets. Right. So go for it, Vikram.
Yep. So in a position where a person is going for a new round and has 2 offers in hand, how much would it make sense to go into what some people may call a reverse auction kind of a scenario?
Okay, I'm going to ask Alok to put this. Alok, this is an enviable position for any entrepreneur.
Yeah, let me play the muted role here. I think it can't let, if it really happens, you're really good. And again,
you're disbelieving of this.
No, I'm not disbelieving.
Let's
I think it's
assume that
not.
I'm really good.
No, I hope it is true. I really wish it is true for you. I think what would really matter again, to be really honest, is not who gives you the best price, but who is the best person to take the money from.
Right.
So you might actually have
the quality of partner.
No, it's very important. Sometimes ignorance drives prices up. And that money can really hit you hard. I call it vampire capital. Have you done diligence on the 2 VCs? Have you spoken to 20 entrepreneurs who got funded by that guy? So is the guy who's putting the bigger offer the guy who's even the nicer guy? If it is, then take the offer. But in a reverse auction, and I think one would just say, look, you're really lucky you're getting a better and better price. I would go back to the guy who has a lower price, whom you probably like more. That's my gut feel. And explain that, look, I think I'm a little short on the value. Do you think we could match it because I have something? And, share, man. I mean, this is a very open world.
But I think that is part of his question, saying what is the venture capitalist's opinion about sharing details of term sheets of other VCs to bargain for a better valuation?
Look, you're commoditizing us, right? I mean, it's effectively what you're...
a two-way thing, right? I mean,
no, so first of all, so we'll look at it the other way. I didn't find 3 companies that look like you and then try to bid on the 3,
exactly.
right? I mean, we said, look, we align, we want to go do this. And again, let's put this in context. You're talking about Series B or Series A after your seed round, or B, whichever way we look at this, right? So there's a lot to be proven still in your business. And a lot to figure out, and hopefully you're going to find someone that can work with you on that. Now, if you turn around and say, I found these 2 guys, they're both really cool, they're both really nice, here's what we're going to do. You guys have till Tuesday at 10 o'clock, you can submit your offer, and I'll pick the one. We're both not giving offer.
Right.
Because that's not the relationship that we're trying to build here. That's not what you might find that in the later stage public markets, and you might find that that's how a system works, because it is a little bit less personal, less uncertain. So
I'll interrupt you, Sandeep. I have a question. Suppose he does have the best winning idea, and there are VCs falling over themselves to fund it, right? And he needs to choose one amongst the rest, and Alok's given some good advice. You've said don't pitch one against the other. But if he does want to share term sheet details, is there any legal protection he needs to put in place, whilst he's negotiating with different venture capitalists so that this doesn't come back to bite him in the face?
Well, for situations like this, there is no requirement for legal protection, because the only time something like that's going to happen is if he's discovered cold fusion or room temperature superconductivity. Otherwise, if you tread that path, it's dangerous, because you're known in the market, firstly, for having done what you did. And I don't think seed funding or angel funding or even venture capital funding, it's rather like incubation as well. These guys are your friends, and they're not private equity investors who are taking you over to flip you for 4 times the value. That's not where they're at. So if you're starting at that relationship, I don't think venture capital is the right place for you.
Okay, next question. And actually there are 2 questions rolled into one, fairly optimistic ones as well. Can a clause for a prospective bridge round from the venture capitalist be included in case of a critical scenario? And I'll follow that up where he talks about how can a promoter demand for an additional payout in case of an exit that was better than what the VC may have originally expected.
I like them both. So the first one's hard. Quite honestly, the first one is we're buying equity, we're in it with you. Basically, so the minute I invest in a company, the first thing we start thinking about is what's the pitch for the next round? Right? I'm not saying how am I going to put the next round in, or how do I, but fundamentally, we're aware of the fact that we're in it together. What you bring is the operational expertise, what we bring is money. Now, there's an unsaid notion that, look, if you're making progress, if you're getting close to that next round, there's probably going to be a willingness to bridge it to that next round, because we've already put in some money, and so we don't want to throw away the money. But look, if everybody in the world has told you this is the worst idea out there, and then you come saying, look, can you give me another $1 million so that we can continue? It doesn't seem likely.
The question comes from the fact, as you said, it's not an efficient process, right? So it just helps in determining when to start looking for your next round. So it could take 6 months, 9 months, a year and a half. So
my rule of math on that is it'll take about 6 months. Take 3 months to close it, 3 months to find the guy.
Right.
So let's say you raise enough money. So that's why when you think about how much money you're going to raise, you want to raise enough money so that you can operate, get to that next milestone, and then have 6 months.
Right.
If you find that you've raised enough money to get you straight till the next round, and that's when you hit the milestone, then you're going to need a bridge, and you know that up front.
Right.
And you probably didn't raise enough money.
Right.
So you have to change your operating plan or revise it up. Revise your operating metric up front. You can use 6 months as a rule of thumb and take your capital in based on that, and design your operating plan based on that.
That's when I run off money.
You want to add that?
We've had an interesting experience actually. We finished our first round, pretty much like Sandeep said, we had a plan, we'd get to this point. And once in a while it could also happen that you did far better than what you expected and you ran out of funds faster than you expected to. But it wasn't a bad situation either. And we didn't have a clause with our current investors that they will give us a bridge, but they just stepped in and gave. And that took us comfortably to the Series B, which was logical, it was the right thing to do. It wasn't about the clause, it was just the right thing to do.
So it's less about the promise and more about the performance, right? I mean, at the end of it, right?
Performance and the confidence, yeah.
Okay. Final question, and that has to do with how long can an investee company or a founder defend his CEO position? Have I articulated that correctly?
Yeah.
What is your key concern here?
The reason why the question comes is that it takes some time for the person in the driving seat to actually put across his idea to the VC too. The VC has his whole understanding about the idea from the business plan and a few presentations that the person may have made over 2 or 3 months for which he or she has been pitching. But post which at least 6 or 7 months during which he is possibly putting it actually in action. And during that time there are certain beliefs that this person may be having regarding team building, regarding the way the company should function, and VC may have another view. So
how do you write in your longevity? Is that the question you're asking?
Yes.
There are 3 ways you could probably lose confidence of the board or the investor in not having you as a CEO. The first is you're not building a great company. Something is going wrong, and despite your best efforts, you're not doing it out of laziness, that you got funded and you stop going to the office from tomorrow. Then you'll get fired. But I'm saying you just can't build the company because of certain dynamics. That's one big problem, which I think you should owe up and say, look, I can't build the company. The second, which I've seen very often, is communication. A lot of people get so caught up building a company, and probably where it's not really visible what's happening at the back end or what's the value being generated, long gestation, technology plays, for example, platform plays. A lot of people get really curious in terms of what's going on, and there's a kind of a question mark hovering around, what is this guy doing? Is he really doing something, or is it just pretense? So I think communicating and even explaining half-baked content or whatever you're doing is very, very important. So keeping communication on is important. And I think the third thing is just how you're selling that company to the market. You see, you could have sold it to your set of investors, but then once you go out there and meet people, a lot of people sometimes are great COOs, but not CEOs. And one has to understand that differential. You know, if you're going internationally and not able to speak at public forums, if you can't really sell yourself as a guy who can build something different,
then you ought to step down yourself.
Then you're a CEO
or take
material.
a different position.
You're an operating guy. You're a tech guy. You're some BD guy. I think the CEO position, like this crown that you want to wear, not you, but I think we covet that position so heavily. Whereas I think if you look at what CEOs really are meant to do, may not even be understood by you.
But the world is full of bad people. He wants to make sure that he can write in some longevity into an agreement with his financiers.
So make it
do
painful
that?
for the investor to kick you out. Okay?
Exactly.
So how do you do that? How do you make it painful for the investor?
You have earnouts firstly. Yeah? Decide on earnouts. If you're kicked out, termination with cause or without cause, drop a matrix of earnouts. That's something we're starting to see now. Yeah? You have it in multiples. If you've had a great 2x EBITDA, your earnout is fantastic, and then you can make a life choice. Do I really want to stick with these guys who think I'm a BD guy when I'm actually the CEO? You might want to ask that question yourself. That earnout is going to act as an incentive and a disincentive for you and the VC, so it works both ways. Then there's the world of equity kickers. Yeah. So you can try and see where you get.
What is an equity kicker?
Well, it depends on the performance of the company. Then you write yourself into a little, on your common stock agreement and your stock restriction agreement, you write in an equity kicker where the performance of the company will give you a kick in terms of remuneration. What happens here is when you look at the anti-dilution clauses, yeah, It's always the down funding which triggers those anti-dilution clauses. So some of the cute questions we've got from companies is, hey, if it is accretive, if they're getting more, shouldn't the conversion rate be lowered? Now that leads us to this equity kicker world. Of course, it's very cute to say that, and no VC in his right mind will ever even look at that kind of a clause.
Is that right?
But
you'd never sign on to a deal if
someone
the
comes
founder
and
was
says,
asking for this kind of protection?
I'll put it differently. If you asked for an aggressive valuation, and then we're unwilling or unable to meet that, and we took a valuation that we're more comfortable with, and we don't do this, but later stage, because we usually come in Series A, but Series B, C, they would consider situations where, let's say you felt your value was 60 million, they wanted to give you, they believe the value is 40 million. So look, if I hit 200 crore this year, then I get 60 million. So okay, that's effectively the equity kicker. Right? And so therefore you're clawing back. But the reality is that benefits the whole previous class, not just you. So it's not an individual, but then you have performance incentives. I mean, but I think Sudipta was absolutely right. You can take that employment contract and do whatever you want with it. But remember also, if you have other management team members at that level, now you got to figure out how you're going to deal with them. And suddenly
As in, how are you going to offer similar protection to them, or how are you going to get away without offering any?
Yeah, so you have an extremely biased contract for yourself.
Yes.
You're not building this business on your own. You have team members there. Now suddenly if they're aware of it, that's going to create challenges for you, your management challenges.
Rules of the startup game. The startup guide to startups.
I'm going to move it on to Bijay because I do know he wants to get his questions in. He's the founder and CEO of Loyalty Rewards.
By the time you get to a Series C, you have your Series A, Series B. Typically, from what I've seen, all of those drag along, tag along, anti-dilution, liquidation preference, I think all of them have different stages. At a certain stage when, like I said, I got funded when I wasn't negotiating so much. I couldn't get, thank you so much for giving me the money. Vis-a-vis Series B, we did negotiate a bit, saying that, listen, organizations build so much. Series C, shouldn't it naturally evolve? And Series C, do investors come to the room with an understanding that it's not like round zero where we can get everything?
In the subsequent rounds, what happens is the amount that can be diligenced is larger. You've got a business that's operated more. So let's talk about Series A. You had nothing. You had a piece of paper. The guy came and said, you seem like a smart guy. Did a few reference calls, said you're okay. Nothing else to diligence. Series B, there's some operating history. We'll look at liabilities, make sure there's nothing there. Series C, you've been running a business. You've got revenue. You've got customers. You've got all sorts of other things in play. All sorts of things that are positive, but can also create liabilities. So suddenly, when you're thinking that rights are going to go lower or less, the reality is the exposure is greater. Exposure is greater because I'm A, putting more money in, and B, you've operated, you're existing, you have potential new liabilities that I don't even know. So the great clause is indemnification, and you spend a lot of time on indemnification. So what are you going to indemnify me for? I'm going to ask for indemnify me for everything in the kitchen sink. You're going to say, I don't want to indemnify you for anything, because how do I know what I'm indemnifying you for? Right? So this is the back and forth.
So you have that negative list vis-a-vis, you do that approach on that one, right? You list down and this is what I'm going to indemnify. You'll say, no, I want a blanket indemnification.
So you'll say, I'll list out what I know is my issues. And I'll say, but okay, that's great. But then everything you don't know could also hit us. Now, why should I be liable for that? Now you'll say, buy owner's risk, right? Yeah. So this is the back and forth that'll exist. Second, you're increasing the exposure for everybody. So as a result, the diligence will be tighter and the restrictions will be much stronger. So I don't think it's a fair view to believe that expectations, right? To believe that it should reduce.
Okay, Bijay, I really hope that answered your question because we're entirely out of time. Thank you very much to all three of you for raising the many concerns that you have, and to all three of you for answering them. Thank you very much for watching.
Rules of the startup game. The startup guide to startups.